Okay, so we're gonna get going now. So we're gonna do this part C, and we'll do part D. Okay. So they say after an assessment of SF Bottling's business case, MBC made the following recommendation: to encourage goal congruency, minimum transfer price principles should be utilized to determine a unit transfer price regarding the transfer of all of the bottles required by SF Winery from SF Bottling. From SF Bottling's perspective, critically evaluate and subsequently conclude whether the recommendation by MBC to adopt the minimum transfer price principles as opposed to the currently proposed transfer price represents a sound financial recommendation. Okay, so you must do calculations and so forth. Okay, so 7 marks is for calculation. So this is a transfer pricing question. So we get a maximum transfer price and a minimum transfer price. You must know which one applies to who. Okay, so the maximum transfer price, that would apply to the buying company. It is basically the maximum price they are willing to pay. For the minimum transfer price, that relates to the selling company, but that is the minimum price they're willing to sell at. Okay, so just take note of that. The whole point of transfer pricing comes about because of a situation where you have a company with many divisions, and the divisions are decentralized. Okay, so that means each division is responsible for their own results. Okay, so what each company will be doing is to maximize their own profits. Okay, that's how they'll be. That is how the performance will be based on. But the ultimate idea is that each division should act in the best interest of the company as a whole. But the problem with that is, in some instances, it may not be to the benefit of their division. So that is kind of where the problem lies. So the transfer pricing principles there's no one solution. There's no this is the best way. But what transfer pricing principles try to achieve is to make both parties happy, meaning the division make them happy, as well as to make to align with what is good for the group as a whole. Okay, so that is basically what we are trying to do over here. So when we're dealing with minimum transfer price, it is the selling division's perspective. So that is the minimum price they're willing to sell at, the minimum price they're willing to accept. Similarly, from the buying division, we look at the maximum price they're willing to pay, the maximum price they are willing to accept. Okay, so it's very important to understand whose perspective we are looking at. So over here, we're looking from bottling's perspective. So bottling must sell to winery. So bottling is the seller, winery is the buyer. Okay, so just take note of that. So let's go look at the scenario. Okay, so we over here, number 3, SF Bottling. Okay, so that's fine. Okay, so number 3 is a short thing. So let's say one of the other companies that will be set up is SF Bottling. The company will manufacture and sell empty wine bottles to both SF Winery and external customers. SF Bottling will have maximum capacity to manufacture 960,000 bottles annually. The bottles come in a standard of 750 milliliter size. Although the expected annual demand for the bottles is 410 and 640 for SF Winery and external customers respectively, SF Bottling will be required to prioritize the supply of the bottles to SF Winery. The grape juice is packed in recyclable 1 liter, 2 liter, and 5 liter containers, which are sourced externally and not from SF Bottling. The maximum manufacturing costs based on maximum manufacturing capacity are estimated as follows. raw material cost per bottle, 550, direct labor cost per bottle, 45 Rand, total annual manufacturing overheads, 2.4 million. Okay, the manufacturing overheads comprise of variable and fixed. Variable manufacturing overheads are estimated at 21 Rand per direct labor hour. Fixed manufacturing overheads are allocated based on the annual maximum manufacturing capacity of the bottles. Okay, so that is basically, we'll be able to work that out. Bottles will be sold to external customers. Bottles will be sold to external customers packed in a custom-made wooden crate just before sale. This crate holds 8 bottles and will always be packed for such, and will always be packed as such for bottle sales. All the crates will be bought from whoever that company is at a purchase price of 12 Rand per crate. SF Bottling has noted numerous complaints from that Botswana's existing customers about the fragility of the crates. In the main, it is complained that unused crate inventory stored for an extended period frequently break beyond repair, and in large volumes, internal sales will not be packed in crates. Okay, so that is important. I'll explain why that is important. Currently, according to the SF Group, to encourage goal congruency, SF Bottling will sell transfer bottles to SF Winery at a price equal to SF Bottling's unit full manufacturing cost per bottle. However, the selling price will be 15.50 Rand per bottle to external customers. Moreover, SF Bottling will incur delivery costs of 85 Rand per bottle sold to external customers only. Okay, so let's have a look what we're going to do over here. So we need to work out the minimum transfer selling price. Okay, so we need to work out the minimum transfer selling price. So let me go straight into Excel. So when we are dealing with transfer pricing, okay, there's a maximum transfer price, and then there is a minimum transfer price. Okay, the maximum transfer price is the easiest. Okay, the minimum transfer price is the more challenging one, but it's not difficult. Okay, so the maximum transfer price is normal selling price plus cost savings. Okay, so that is basically that. The maximum transfer price. So max transfer price is from the perspective of the buying division. So what's happening over here? The maximum transfer price is from the perspective of the buying division. It is the maximum price they are willing to accept. So what are we doing over here? The normal selling price is basically the price they will be able to get if they go to an external provider. Okay, so the way they're going to work out their cost is basically the price that they can get from an external supplier plus, I call it cost savings. What is cost savings? Cost savings is just basically they may have to incur an ordering cost. Okay, so for example, in order to buy from an external supplier, there's a commission they have to pay, or a order cost that they have to pay. So there may be a delivery cost that they have to pay. There's some cost that is specifically incurred as a result of buying from an external supplier. So ultimately, the unit cost the unit cost that they will incur if they buy from an external supplier would be the price they must pay the supplier plus any other additional costs, like ordering costs or a commission cost or a transport cost. So it will be clear in the question. Okay, if there's an ordering cost or some other cost that they have to incur. So the price that they're willing to pay would basically, the maximum price would be equal to what they would pay to an external company. Because if they must pay 50 Rand to an external company and 50 Rand to the internal division, they're okay because there's no difference. But the moment they need to pay 55 Rand, then there's a problem. Because why must they pay 55 Rand to an internal company if they can pay 50 Rand elsewhere? Okay, so that is why the maximum price would be what they would pay for to buy externally. So how do we get that amount? It is normal selling price that they'll pay the external supplier plus any, I call it cost savings, but basically it's other costs that they would incur if they were to go external. So an ordering cost, a transport cost, or something of that nature, that would make it very, very clear. Okay, that's the easy one. The minimum transfer price. Okay, so the minimum transfer price is from the perspective of the selling division. Okay, so they would want to receive an amount, the least amount they would want to receive is what they would get if they sold to someone externally. So if they will get 50 Rand from an external, if their net profit from an external supply, from an external customer is 50 Rand, then they would want their net profit to also be 50 Rand from the internal division. So if they can get 50 Rand from an internal division, I mean from an external, if they can get a 50 Rand net profit from an external customer, then they would also want 50 Rand at the minimum from the internal division. If the internal division is only willing to pay them 45 Rand, then why must I sell to the internal division if the net profit from the internal division is 45 Rand, whereas they'll get 50 Rand from an external customer? So that is basically why we work out the minimum price they're willing to accept when we're looking at the selling division. Now, the minimum transfer price may appear it is more difficult than the maximum transfer price, but in its own, it's not difficult. It may just look confusing. The formula for the minimum transfer price, it is variable costs plus contribution margin. Okay, so it is variable costs plus contribution margin. So think of it, so the minimum transfer price is variable costs plus contribution margin. But now I want to put some detail next to each one of it, because it's not any variable cost, it is not any contribution margin. So the starting point of thinking about this is the minimum transfer price is variable cost plus contribution margin. That is the base level. But now we need to add some detail, because it's not any variable cost and it is not any contribution margin. Okay, so what is the detail relating to the variable cost? It's the variable cost to produce for internal sales. Okay. So it's the variable cost to produce internally. So for example, the cost to produce a bottle, whether it is internal or external, will be exactly the same. They're not going to make they're not going to change the process of making bottles for internal and external. It's the same bottles they are selling internally and externally. So the production cost will be exactly the same. However, there may be other variable costs that differ between the internal sale and the external customer. So a typical example would be there may be a selling commission incurred if they must sell to an external customer. That's one example. Another typical example is the packaging. So for an internal customer, they may not package, but for an external customer, they have to package. I'll give you an example. Let's just say, for example, let's just say, for example, there's a milk division, right? This is a company that is a dairy company. They have a milk division, and let's just say they have a cheese and yogurt division, right? Now, in cheese and in yogurt, they use milk. So the milk division sells to the internal customer, and they sell to an external customer. And let's just assume that both the milk division and the cheese division is on the same premises, right? So when the milk division sell to external customers, they have to package the milk into packets or into boxes, as you see in the shop, right? So they would incur that packaging cost to sell to the external customer. But when they sell to the internal customer, because the internal customer, he doesn't want a completed milk, doesn't want a packaged milk, because they're going to use the milk in cheese and in yogurt. All they're going to do is, let's say the milk is currently in drums. They'll just basically send the drum over. You understand? So there's no packaging cost incurred to sell to the cheese and yogurt division. So that is the concept over here. So this variable cost is the variable cost incurred to produce internally. The actual product cost will be exactly the same, but there may be additional variable costs that differ between the external customer and the internal customer. The external customer may have packaging costs, the internal customer does not. The external customer may have a commission, whereas the internal customer, there's no commission. So you might just look clearly from the question. So in some cases, there's no difference. In this case, there is a difference. Okay, so very important to understand that. So first level, minimum transfer price, variable cost plus contribution margin. And then second level is to add the detail. The detail is that is not any variable cost. It is a variable cost to produce for internal sales. Then we have contribution margin. Okay, now we need to add the contribution margin. We all know what contribution margin is. Contribution margin is sales minus variable costs. Okay, so over here, the contribution margin relates to sales, relates to external sales foregone. Okay, so that relates to external sales foregone. How do we work out contribution margin? Contribution margin equals selling price per unit minus variable costs. Now, what's important, in this formula, we have variable costs. In this formula, we also have variable costs. Okay, because contribution margin is sales minus variable costs. What's critically important to understand is that this variable cost relates to variable cost to produce for internal sales, whereas this variable cost relates to variable costs to produce for external sales. Why? Because we're working out contribution margin from external sales foregone. Okay, so that's the important aspect that you must be aware. So just keep that in mind. So when we work out variable costs, we work out variable costs on two levels. Variable costs to produce internally, and then variable costs to produce externally. So that's very, very important. So the way I recommend that you think about it, always think on high level first. So the highest level is that minimum transfer price is variable cost plus contribution margin. The second level, when I go at the highest level, is the most basic, the big picture. As you go down each time into a different layer, you then go into more detail, more detail, more detail. So therefore, level one, it is simply minimum transfer price, variable cost plus contribution margin. Now we go into the next level, which is slightly more deeper. The variable cost is not any variable cost. It is variable cost to produce for internal sales. Then we have contribution margin. It is not any contribution margin. It is contribution margin relating to external sales foregone. Okay, so just keep that in mind. So now we need to work out the minimum transfer price. Okay, so let's work it out. So the minimum transfer price, we need variable costs. Okay, so to produce for internal sales. We need contribution margin relating to external sales foregone. Remember, there won't always be a contribution margin, but I always recommend that you write the formula in full. And if there's no contribution margin, there's no external sales foregone, you simply put a 0. Why? You want to train your brain to do the same thing over and over. Okay, so there's no need to think. You just have a look, write the formula as is. If there's no contribution margin, you simply put a 0. That's simple. Don't try to figure out is a contribution margin or not. Just put the formula in, and then if there's no contribution, as you work through the question, you put in a 0. Okay. Okay, so total cost. Then we're going to say internal selling units. Okay. Then we're going to get min TP per unit. Okay, so that is basically what we're going to work to. So we're going to work out, the detail comes in working out that and working out that. Okay, so let's start. Okay, so the bottling company, so we can already work out capacity and all of those type of stuff. So if you want to know if there is a minimum, if there is a contribution margin, you can work out the capacity. Okay, so let's first work out the variable costs. Okay, so the variable cost to produce is going to be this over here. So let me just quickly see that the manufacturing costs based on maximum manufacturing capacity are estimated as follows. Raw material cost per bottle, 550. Direct labor cost per bottle, 45 Rand per hour. And then, okay, so let's have a look. So I'm going to put my workings over here. Okay, so working one, we're going to work out variable costs. Okay, so we have raw material. Okay, so we have raw material. We have direct labor and variable manufacturing overheads. Okay, so this was 550. This was 450. Okay, then they said over here for the variable overheads, for the variable manufacturing overheads, the variable manufacturing overheads are estimated at 21 Rand per direct labor hour. Okay, so we know it's 45 Rand per hour. But only 450 has been used, so we can work out how much time each glass bottle have. So all we're going to do over here, we need to work out okay, so we need to work out the variable overheads per bottle. We know it's 21 Rand per direct labor hour. So we need to work out how many direct labor hours it was used. Okay, so we know it's 21 Rand per direct labor hour. So we need to now determine the number of direct labor hours that have been used per bottle. So we know that it's 45 Rand per direct labor hour and allocated only 4.50. So all we can do over here is say 4.5 divided by 45. So that will tell us how many hours have been used. Okay, how many hours is allocated per bottle. So then the variable manufacturing overhead is 21 Rand times 4.5 divided by 45. Okay, so this is going to be variable production costs. So remember, whether you sell internally or externally, the production cost will remain the same. Okay, variable production costs. Okay, now we must have a look if there's any difference between internal and external production variable costs. So now they say bottles will be sold to external customers packed in a custom-made wooden crate. Okay, so they're telling you it is at a cost of 12 Rand per crate. Okay, so the 12 Rand per crate, and there is 8 bottles per crate. So that means, and they won't do this to internal sales. So so this is variable production costs, and this is also variable costs for internal sales. Okay. Okay, so this is packaging costs. This packaging cost only applies to external customers, so therefore we put it below. Okay, so internal is going to be 12 Rand 10. Packaging costs is going to be 12 Rand per crate, but each crate takes 8 bottles, so therefore the cost per bottle so therefore cost per bottle, it is going to be equal to 12 Rand divided by 8. Okay, because each crate can take 8 bottles. Okay, so we covered that aspect. You know, also currently according to the SF group to encourage, okay, whatever that is. So then SF bottling will incur delivery cost of 85 cents per bottle to external customers only. Okay, so internals will not be packed in crates. Okay, so there we go. Delivery cost per bottle 0.85. Okay, so what we are doing over here, we are working out the variable costs for internal sales and also the variable costs for external sales. Okay, so we did 2 over there. So over here, it is going to be 12.1 multiplied by the number of units to sell internally. So if I go back to the question, internal sales is 410, external sales is 640. Okay, so 410 and 640. Okay, so 410, 1, 2, 3. So all I'm going to do, I'm going to say 1210 multiplied by 410, 1, 2, 3. Okay. Another way to keep the numbers, we can actually do it like this. Working 2, internal sales, external sales, total required bottles, so internal 410, 1, 2, 3, external 640, 1, 2, 3. Just make sure I'm using the right numbers. But that's what I kind of remember now. Okay, so 1050. So what we're going to do is we're going to make this formula linked to Excel. Okay, so there we go, 4160. Now we must do contribution margin. Okay. So for contribution margin, what we are interested over here is to have the way we'll find out whether we have whether we have to forego sales. We'll only have a contribution margin if we have to forego sales. Okay. The only time we're going to have to forego sales if there's a shortfall. So we have to work out spare capacity. So the way we work out spare capacity is as follows. Okay. So the way we work out spare capacity is as follows. Maximum capacity. Okay. I'm gonna do a step in here that is not in this question, but I have seen it a few times in other questions. So I want to bring it in so you are aware how to deal with a situation of that nature. Okay. Okay, then we're gonna say less contractual external sales, less less non-contractual external sales. Okay. And it's going to give us spare capacity. Okay. Required for internal sales. And then we'll have required for internal sales, and then we would have surplus or shortfall. If we have a shortfall, there will be a contribution margin. If we have if there's a surplus, there's no contribution margin. Maximum capacity 960. Okay, so that has been given. So in a question, it could be that you have a contract where you must supply an external customer because you sign a contract that you will. So you have no choice but to provide them. Okay, in this question is not of that. There's nothing of that. I just wanted to show you so that if you come to a situation of that nature, you must separate that out because you have to first provide that customer hours they can take you to court before you can deduct from before you can supply your internal customer. Okay, but what we do know that is the external customer. So therefore, it will be that minus what you're contractually required to do minus what you're not contractually required to do. So your available capacity is 420, but you need 410 for internal sales. So available capacity minus internal sales, it is 90,000. So there's a shortfall of 90,000. So that means you're going to have to forego 90,000 of these sales. Okay, so remember, you can't forego that level. You can only forego on this level. Okay, so you have to forego 90,000 sales. Okay, so we're going to have to work out the contribution margin for per unit for external sales. So therefore, working for, we're going to work out contribution margin per unit. Okay. External sales foregone. Okay, so how are we going to work that out? It is selling price. It is 15 Rand 50. You can just confirm that I'm taking the right number that was given. Then it's going to be variable costs for external customers. So over here, we're going to use working one, but we must use this number over there. Okay, so this here is going to come from working one. So the external to external sales is 14 Rand 45. So therefore the contribution margin per unit, is that minus that. Okay, so it's 1 Rand 5 cents. Okay, so now to work out extra contribution margin foregone, it is 1.05. So here's the important aspect. We don't multiply by 410,000 units, okay, because that's not the number of sales that we are foregoing. We must multiply by the number of sales we can afford, we have to forego, we have to lose. We only have to lose 90,000, okay? So please be aware of that. Many people multiply this by 410,000. It's not the number of units for internal sales. It's only the number of units for external sales that you have to forego. Okay, so therefore, if I multiply, it is 105 multiplied by 90. Okay. Okay, so just be aware of that. It needs to be positive. So therefore, the cost is basically the total cost that the selling division would want to take into account is the cost to produce for the internal customer plus the contribution margin they are losing from external sales to produce for the internal customer. Okay, then we bring in the number of units that they have to produce internally. So the minimum transfer price per unit is going to be that divided by that. So what they want to sell at is 12 Rand 33. So they will want a minimum of 12 Rand 33 to sell to the external customer. I mean, to sell to the internal customer. So that's the process that you have to follow. I just want to make sure that they asked us for a price per unit. Let me just check quickly. Okay, so we need to okay, so the price they don't tell us whether it's price per unit or not. We now still need to we did the calculations, we need to evaluate and conclude. What did they say? Can't remember. The currently according to the SF group to ensure okay transfer price, the price equal SF bottling unit full manufacturing cost per bottle. So the full manufacturing cost per bottle. Oh, okay. So what is the full manufacturing? So the full manufacturing cost per bottle is currently the following. Okay. So they want to sell the full manufacturing cost. So working 5. The full manufacturing cost is as follows: variable costs, fixed costs. Okay, so variable costs, manufacturing costs. Okay, so take note of that. They're not worried about transport costs. They're not worrying about packaging costs. They just want manufacturing costs, which is a 12.90. And then we must work out the fixed costs. So the way we're going to work out the fixed cost is as follows. Okay, the way we're going to work out the fixed cost is as follows. So we know the total manufacturing overheads is 248. We can work out what is the variable manufacturing overheads. So then we will be able to work out what is the fixed component. Okay, so let's have a look. So working 6, total manufacturing overheads That is 2448123. That was given. Okay. The variable manufacturing overheads would be as follows. Okay. It will be 21 Rand per direct labor hour. Okay. Was I saying manufacturing overheads are allocated at 21 Rand per direct labor hour. So we need to work out how many labor hours. So we need to work out what is the labor hours per bottle. We already did that above, which is 4.50 divided by 45 Rand. So this is going. So 4.50 divided by 45 Rand. That is the labor hours per bottle. Okay. Then we are so labor hours per bottle. If we multiply that by the number of bottles, which is 960,000, so labor hour per bottle multiplied by the number of bottles will give us the total number of labor hours. Okay, so total number of labor hours multiplied by 21 Rand, that's what our variable cost would be. So it is 21 multiplied by 4.50 divided by 45 multiplied by 960. 1, 2, 3. Okay, to show, I'm going to do it separately over here, not as a working. Okay, I'm going to work it out for you, but I'm not going to include it as part of my formal workings. I just want to show you. Okay, so labor hours per bottle. Okay, it's going to be 4.5 divided by 45. Okay, so it's equal to 4.5 divided by 45. Okay, so 0.1 hours. Okay, then we're going to say number of bottles, which is going to be 960. That is given. Okay, so this will tell you the total labor hours. Okay, so it'll give you total labor hours. So it's going to be that multiplied by the number of bottles. So the total labor hours is 96,000 hours. Okay, and then we're going to say variable manufacturing overhead costs per hour. 21 Rand, that was given. Okay, so therefore, variable manufacturing overhead costs is equal to number of labor hours times the variable cost per labor hour. And that's basically what we're getting. Okay, so I just wanted to show you if we do it step by step. I did one calculation, but I wanted to show you when you do it step by step. So that and this is the same. Okay. Okay, so then if we work out, so now we have fixed costs, fixed manufacturing overhead costs, which is going to be 248 minus 2016. So it's 432,000 Rand. Okay. Now they told us what manufacturing overheads are based on. Manufacturing overheads are allocated based on the annual maximum manufacturing capacity of the bottles. Okay. So allocation basis. Okay. Maximum capacity. Okay, that's the allocation basis. Maximum capacity. So maximum production capacity. Okay, so therefore the maximum production capacity is 960. So therefore, so this is basically your fixed overhead rate, okay, which is cost per bottle. It is that divided by that, 45 cents. So the full manufacturing costs per bottle, the full manufacturing cost per bottle is the sum of the two. Okay, so it's 12.55 Rand, whereas we recommend how much? 12.33 Rand. Okay, so we must conclude, okay, min TP equals 12.33, full manufacturing cost per bottle so that's working 5. Okay, so the minimum TP is lower than full manufacturing costs. Okay, state obvious. Okay, it's higher, or state obvious. Okay, whichever way you went. If you said higher, then it's also okay. If you said full manufacturing is higher than minimum, that's fine. Okay. To achieve goal congruence, the minimum TP is the better option. Okay, why? Using the full cost method would not incentivize the selling division, the bottling division to manufacture bottles in an efficient manner. Okay. Therefore, we recommend or suggest, whichever word they use, recommend or suggest, we therefore recommend or suggest using the min TP to achieve goal congruence. Okay. So what would happen if manufacturing cost is higher, right? So if they must allocate based on full manufacturing costs, and that means they won't care what the cost of fixed overheads are, because in the end they are able to transfer it over to the customer. If they are unable to transfer the fixed overheads to the customer, then the selling division would make a concerted effort to make sure that that fixed overheads is as low as possible. They will operate in an efficient manner. When you are able to transfer all your costs to someone else, so someone else will pay for your costs, you won't care what costs you incur, because you know in the end someone else is going to be paying for it. And that is why you don't want to include fixed costs, because fixed costs won't incentivize a company to operate in an efficient manner. Okay, so that is basically that question. Is there any question on your side on this? Sorry, Serena.
Hi, please say you brush over the steps to get into this final answer, because I think I got a little bit lost.
Okay, so from when you say the final answer, where this over here or this over here?
I think when you're calculating the full manufacturing cost per bottle.
Okay. So in a normal transfer pricing question, in a normal minimum transfer pricing question, we will stop over here. Okay.
Yeah.
Or in a normal transfer pricing question, we will stop over here. in this particular question, we needed to go to this step over here. The reason being is, let's have a look at what the required say. So let's have a look what the required have to say. So yeah, to encourage minimum transfer price transfer price principles should be utilized to determine, okay, whatever that is saying. So they say from SF bottling perspective, critically evaluate and subsequently conclude whether the recommendation by MBC to adopt the minimum transfer price as opposed to the current proposed transfer price represents a sound financial recommendation. So we need to tell them whether the minimum transfer price is better than the current transfer price. What is the current proposed transfer price? So we have to look in the question. So they didn't ask us. So in a normal question, they say, dear student, calculate the minimum transfer price. They didn't say that. They said, dear student, determine whether the minimum transfer price is better than the current proposed transfer price. So that means we need to know what is the minimum transfer price. So they're indirectly telling you calculate transfer price. And we also need to know what is the current proposed transfer price. So that in the first step, we did calculate the minimum transfer price. Now we need to identify what is the current proposed transfer price. In another question, they'd have told you exactly what is they'll give you the answer to the proposed transfer price. In this case, they gave the answer indirectly. They are telling us, currently, according to the SF group, to encourage goal congruence, SF Bottle will sell transfer bottles at a price equal to SF Bottling's full manufacturing costs per unit. Okay, so the current transfer price is the full manufacturing cost per unit. They did not tell us what is the full manufacturing cost per unit, so that means we need to calculate it. So how do we know we need to calculate it? Because they're saying, dear student, in the required C, they are saying, dear student, please calculate, please comment, please evaluate whether the minimum transfer price is better than the current proposed transfer price. So they never gave us the minimum transfer price. So that means we need to calculate the minimum transfer price. That's what we did in the first step. Then they told us what is the proposed current transfer price, which is the full manufacturing cost per bottle. However, they never gave us the unit amount. So that means we need to calculate the unit amount. So that is basically what we are doing over here. We worked out the minimum transfer price because we need to know it. But in order to comment, we need to know the minimum transfer price, plus we need to know the current proposed transfer price, which is the full manufacturing price. And that is what we determined over here. Do you understand up to that point so far? We'll get into the numbers now.
Yes, I understand everything now.
So you're happy with why we did this part? So this, we would stop normally over here. We only did this part over here is because the question told us we need to comment. Only way we can comment is to do a comparison. So when we do the full manufacturing cost, we needed to work that out. So full manufacturing cost is simply because the company is using absorption costing method. So remember, right at the beginning, they told us this company is using the absorption costing method. So because the company is using the absorption costing method, the full manufacturing price is direct material, direct labor, variable manufacturing costs, and fixed manufacturing costs. So here, right at the bottom, we already did variable costs, okay? Variable production costs, which is the 12 Rand 10 in working one. Now, all we needed to do is work out what is the fixed cost per unit. And that's basically what I did over here. And that's how we got that. So now we know the full manufacturing cost, which is the current proposed transfer price. Only now can we do an evaluation. We can't do an evaluation otherwise. Okay, but a common aspect over here is that with the problem with the full manufacturing method is that if you use the full manufacturing method, it does not incentivize efficiency because you know that you can transfer the full cost to the customer. So why must you care what the manufacturing cost is if you will get it back through your selling price? Okay, so that is basically that aspect. Does that explain your answer, your question, or do you need to
Yes.
understand how we got the fixed costs? Okay, Sarika, anything your side?
No, I'm okay, thank you.
Okay. Let's have a look at the next question. You want me to do this question? Or can we move on to finance? So I have load shedding at 12 o'clock. Let me know. You want to do this question? Yes, no?
Can we do the finance question? Yeah, the finance
NPV.
question, because that was a bit tricky for me, I think.
You happy with that, Serena? That's how Serena
Yes,
for you. That's how I pronounce your name.
Serena.
Serena. Okay. So you happy with that? We'll do the finance NPV.
Yes, fine.
Okay, so they say, I'm going to go to this one, the 17 marker. Calculate the NPV in South African Rand for each of the two capital investments, applying the information provided in the scenario. Okay, so let's have a look. Where is this now? This 1, 2. Okay, so this is the whole question. Okay, so let's just quickly have a look what's happening over here. So they say Pepper Clothing is a clothing retailer in South Africa with its head office located in Cape Town. It sells low-cost clothes to mass, lower to middle income in customers. Pepper now owns over 1,500 stores or franchise stores and employs more than 14,000 employees. The company has stores across South Africa with strong presence in Gauteng, the Western Cape, and Limpopo. Pepper is the largest single brand retailer of low-cost clothing in South Africa, and its board believes that there are opportunities to take advantage of the rapid economic growth in some African countries. Okay, so they're talking about Pep clothing, okay? The latest market research indicates that discount clothing stores offer the greatest opportunity for future growth in Southern Africa. And as a result, the finance director has identified 2 investment opportunities. Both these investments can be undertaken, but the board has put some financial restrictions on how much can be expended on capital investment over the next few years. Details about the 2 investments are as follows. Okay. So because there's a constraint, we probably have to choose between the 2. Okay. Investment 1 and investment 2. So build a new discount clothing store in the Western Cape. So the Western Cape offers the smallest number of discount clothing stores as a percentage of the gross domestic product of any province in South Africa. Pepper has already opened discussions with a seller of suitable land as well as the local authority. If this acquisition is approved, there will be some financial assistance available to a purchaser such as Pepper. However, a decision is not expected from the local authority for at least 1 month. Pepper has paid a non-refundable holding deposit of 50,000 Rand on the freehold land pending the outcome of its investment appraisal. The seller requires a decision within a month. The investment appraisal will have to be done over an indefinite period where a terminal value must be established. Okay, so that there's a sunk cost. Okay, so just take a note of that. Investment 2, build a new discount clothing store in Zimbabwe. Pepper's own branded products are already being bought and sold on by some retailers in Zimbabwe. These products have proven to be very popular, although the supplier lacked the resources to maintain sufficient stock levels and provide a variety of quality good customers. And provide a variety of quality goods to customers. The Zimbabwean government is keen to attract inward investment, although it generally insists on some investment, although it insists on some involvement in the investment and puts certain restrictions in contracts. A suitable site is available for Pepper to build its store and operate from there for a period of 15 years. Today's cost of using the land over the next 15 years and disposal of the building at the end has already been calculated. The United States dollar is widely used in Zimbabwe, and all payments in Zimbabwe can be made in USD. Okay, so capital cost for both investments. So cost of freehold land, 36,000 Rand. Cost of use of land, I don't know what that is, 2,000 Rand. Building cost, 50,000. Building cost, 3,200. Equipment cost, 14,800. Okay. Now they say the projected profits for both investments. Cash profit, 28.31. Okay. So this is in USD. So we'll have to have a look in terms of, the exchange rates. Okay, so other information. Under investment 1, income and expenses are expected to increase by 6% per annum from year 4 onwards. This is approximately the expected rate of inflation in South Africa. Current spot rates are 14.80. Assume the risk-free interest rate are currently 8% in South Africa and 5% in the US. Okay, these rates are likely to be maintained until the end of year 3. Finance Director has concluded that the forecast for interest rates and future inflation in Zimbabwe is unreliable. The directors of Pepper therefore assume, for convenience, that in investment 2, the income receivable in year 3 in South Africa Rand terms will remain constant in nominal terms until year 15. Okay, we'll need to read this again. The directors of Pepper therefore assume, for convenience, that in investment 2, the income receivable in year 3 in South African Rand terms will remain constant in nominal terms until year 15. Okay, so we'll see what to do with that. Operating costs assumed to be 60% of gross profit received each year in both investments. Okay, so happy with that. Operating costs of gross profit, okay, so we're happy with that. For the purposes of this evaluation, depreciation or capital allowance on land must be ignored. Okay, great stuff. Both operations will be located in, okay, IDZ, okay. This provides for accelerated wear and tear allowances, and equipment can be written off over 2 years for tax purposes. Refurbishment of buildings and the replacement of equipment will be needed within the life of both investments, but these costs have not as yet been identified and have been excluded from the evaluation. Okay. If investment 1 is chosen, in addition to other operating costs, storage costs will amount to 1% of the store's gross profit. If investment 2 is chosen, it will result in a decline in profits generated by the South African operations. This 5 million Rand annual loss is expected to remain fixed. Okay. If investment 2 is selected, all profits from Zimbabwe will be repatriated to South Africa at the end of each year. The taxable income will be taxed at the rate of 28%. Okay. The tax is paid in the same year as the cash flows. Okay, that's fine. Assume all capital costs are incurred in year 0 and all operating cash flows are received or incurred at the end of each year. 12% is considered to be an appropriate discount rate for investment one. A premium on this South African rate of 400 basis points is considered appropriate for investment two. Okay, cool. Okay, so let's have a look. Okay, so it's a lot of information, but we'll do both concurrently. I just need to have a look what would be the best approach to actually do this. Okay. So we're going to do Q2B, I think. So let's just quickly have a look. It was Q2B. Okay. So we need to calculate the NPV in South African Rand for each of the two capital investments applying. Okay, so let's go and do this. So same principles, not much difference. So there's a lot of information going on. Okay, so we just need to keep our head straight as we go through this. Okay, so this is Western Cape. Okay, actually, investment one. Investment two. Okay, so we're gonna have details. We're gonna have year 0, year 1, year 2, year 3. Okay. So we're gonna have the capital cost is cost of freehold land, cost of use of land. Okay, maybe I can just do that. Okay, so we'll do that. Then we have cash gross profit. Then we have cash operating costs. Okay, so those are the common ones in both. We will add anything else as we go through the scenario again. So all I'm going to do is the following. So what I'm going to do over here, I'm going to leave a line because we most likely have to add some more line items. Okay. Cash flow before tax. Okay, we're going to have tax. Okay, then we're going to have net cash flow after tax. Okay, so that is basically what we'll put over there. Then we will have our discount rate, which is WACC. Okay. And we're going to have present value. We're going to have value year 0. So remember, I always, for when we do Excel or Google Sheets, we have to put in the value for year 0 because Excel will only take that into account, year 1, year 2, and so forth. Excel and Google Sheets do not take year 0 into account. When you use your financial calculator, the financial calculator takes from year 0 into account. So you don't need this line item when you do a financial calculator because you're already taking it into account over here or over there. But for our purposes, for when I use Excel or Google Sheets, I need to bring in year 0. So my year 0 will simply equal that line item over there. My present value, I'll do the formula when we get there. And then this, it will be this over here. Okay, so there we got NPV. Okay, I'm going to add some more lines. What we're definitely going to have over here is terminal value. Okay, so usually you don't have a terminal value. We are used to not having a terminal value in capital budgeting because the project is just 5 years, right? I mean, they give us information for 5 years. In this case, the project is 15 years, but they only give us information for 3 years. So therefore, we need to bring in a terminal value. This works the same as in as we would do when we're dealing with valuations, the free cash flow valuations under the topic of valuations. Okay. Okay, so more or less the same. There will be some differences, but most of those items are the same. Okay, so let's get going. So we're going to go through it in chronological order as the scenario puts them, and we would then plug in the numbers as we go along. So I'm setting up both. So I don't want to do investment 1 and then read through all the information and then do investment 2 and read through all the information again. I'll do both concurrently. Okay. So let's have a look what's happening over here. Okay, is there any numbers? Okay, so here's the Western Cape offers a small discount stores. Okay. I read that. So Pepper has paid a non-refundable holding deposit of 50,000 Rand on the freehold land pending the outcome of its investment appraisal. The seller requires a decision within 1 month. The investment, okay, so it's non-refundable. We paid it already. We are only interested in future cash flows. So remember, we already paid this investment. If number 1 does not take place, we lose the 50,000 Rand. Okay, so therefore, the fact that we paid it already is irrelevant. Okay, so we don't bring that in. So building costs. I'm assuming that was the building cost. People has paid a non-refundable. I don't know if it's the same thing now. People has paid a non-deposit. No, it's not the same thing. Okay, so I'm gonna bring in the deposit over here. I'm not now sure. I'm assuming it's 2 different stuff. Okay, so I will put in here a refundable deposit. I mean, what was it? Was it a non-refundable? Is it 50K now? A non-refundable deposit. So non-refundable deposit, put it in 0. And we're going to call it sunk costs. Okay, so you must bring it in, tell them it is 0. So just be aware of that. Okay, they paid it, but it's a past cost. Okay. Next, okay, nothing there. Okay, 15 years. Okay. So I just want to say a suitable land is available for Pepper to build its store and operate from there for a period of 15 years. Today's cost of using the land over the next 15 years and the disposal of the building and the disposable of the building has already been calculated. Okay, so we'll just use that then. They only gave us one exchange rate, so remember there are two approaches over here that you can do. You can either work it out in dollars and then translate at the end, or you can translate immediately. Okay, so I'll just translate immediately. So I need to see the risk-free rate, 8% using 5%. Okay, so I'm just gonna put it in immediately. Okay, so 36,000 Rand. Freehold, they told us it happens in year 0. So 36,000. Cost of using the land, there was nothing. Then it's 50 and 14. 50 and 14. 50K, 14K. Okay. Okay, then for this one, there's nothing. Cost of freehold and cost of using the land is 2,000, 3.2, and then 800. Okay, 3,000, 2,000. So there's nothing over there. So it's going to be 2,000. I think 3.2. Just make sure I'm using the right numbers. And then 800. Okay, so that is that one over there. Okay, so we dealt with the initial, so we covered things over here. We dealt with everything else. Okay, so we're happy with that. So they say the projected profits for both investments are as follows: 28, 31, and 35. 28, 31, and 35. Projected profits for both investments. Under investment 1, income and expenses are expected to increase by 6% per annum. Okay, so 28, 31, and 35. So cash profit, we won't put it into year 0, we put it into year 1. So it was 28,000, 31,750, and I think 35. Just having them taking the wrong numbers. And then we have 5,565, 5,565. So here we have so let's just plugging in 5. Okay, 5,750. Okay, and then it was, what was the other one now? 6,500 times 14.8. Okay, so there we go with that. Next it is, so there we go. Okay. Okay, so number 1, this one over here, we will deal with when we work out the terminal value. That one over there, we will deal with when we work out the terminal value. Okay. Then they're saying the current spot rate is 14.80. We did that. Assume that the risk-free rates are currently 8% in South Africa and 5% in the UA. These rates are likely to be maintained until the end of year 3. Okay, so they're giving us the risk-free rate. We don't know what beta is. I don't know what the market rate is in the risk-free rate. Okay, not sure what to do with that. We'll have a look. We'll have a look just now. So uninvestment income is okay for here. This is approximately okay. I don't know what to do with those rates. Okay, so I'm not going to worry about that for now. Then they say the finance director has concluded that the forecast for interest rates and future inflation in Zimbabwe is unreliable. The directors of PEPA therefore assume for convenience that in investment number 2, the income receivable in year 3 in South African terms will remain constant in nominal terms until, okay, so we're happy with that. I'll know what to do with that, so that's fine. Operating costs are assumed to be 60% of gross profit each year in both investments, okay? So operating costs, 60% of gross profit. So all I'm going to do over here, I'm going to say equal negative that multiplied by 60%. Okay, and it applies to both. So I can just bring it over there. Okay, so I can just bring it over there. So we're happy with that. So like I said, I know what to do with number 1, with bullet point number 1. Okay, not too sure about this thing over here, about this interest rate thing over there. We'll see how to make use of it just now. I have an idea what to do over there. Okay, so when we come to the terminal value, I'll know what I need to do over there. Operating costs, we took that into account. Then they say for the purpose of this evaluation, depreciation or capital allowances on land and buildings, including use of land, must be ignored. Okay, cool, we'll ignore it. Then over here, both operations will be located in the industrial development zones. This provides for accelerated wear and tear allowances, and equipment can be written over 2 years. Okay, so this provides for accelerated wear and tear allowances, and equipment can be written off over 2 years. Okay, we'll have to have a look regarding the buildings. So we'll do wear and tear on equipment over 2 years, so that's fine. When we do the tax calculation, we'll deal with that. Refurbishment of buildings and replacement of equipment will be needed within the life of both investments, but these costs have not yet been identified and have been excluded from the evaluation. Okay, so we're excluding it, so that's fine. Okay, so now we come to specifics. So what we must still do, we must still bring in this tax implications into account. Okay. Okay, so what we can do with the so the tax on the buildings. Okay, so I'm going to do it over here quickly. Okay, so there we will deal with that. Okay, so we'll just, I would copy this over quickly. So in this scenario, we can just do it like that, or you can do a separate tax calculation. Does not matter what you want to do. Because they're giving the tax so separately, I'm going to do it this way. Okay. So now let's have a look. So the tax on buildings can be ignored. So tax on land and buildings can be ignored. So therefore, I'm going to put in over here 0, 0, 0. Okay. Then they are telling us that tax on equipment can. So so remember, the equipment, the tax on equipment is a reduction, so that increases our cash flow. So all we will do is we'll say we want that to be positive, okay, and we're going to divide it by 2. Once again, we're going to make that positive, and we're going to divide it by 2. But remember, you must multiply this by 28%. Because tax is at 28%. So why must it be positive? because as a tax deduction, it increases our cash flow. Okay, so take note of that. So do the same over here. Tax on equipment. So this tax on land and buildings, they told us to ignore it. Okay, and then written off over 2 years. So it'll be that divided by 2 times 28%. They told us it's going to taxes going to be based in South Africa. So it's going to be that divided by 2 times 28%. Okay, so there we go. There will be nothing over here. Once again, because of the tax deduction, it will increase our cash flow. Okay. Okay. Now we go back to the question. So we dealt with operating costs. We dealt with this thing that must be ignored. We dealt with the capital allowance, the equipment. Then they say this, okay, we're not going to worry about that because it's been excluded. We don't know the numbers, so we can't make up numbers. Okay. So then they say if investment 1 is chosen, in addition to other operating costs, storage costs will amount to 1% of the store's gross profit each year. Okay. So now we bring in those extra costs. Investment number 1. I'm going to have storage costs. Okay, so this is going to equal to gross profit times 1%. I make it negative because it is a cost. Okay. So that is what they told us over here. If investment 1 is chosen, in addition to other operating costs, storage costs will amount to 1% of the store's gross profit each year. So that's what we did. If investment 2 is chosen, it will result in a decline in profits generated by the South African operations. This 5 million rand annual loss is expected to remain fixed. Okay, so it's a 5 million rand annual loss. So we must add this as a cost to investment number 2. So if we choose investment number 2, there's an opportunity cost. They're going to cause that the South African operations will lose 5 million rand. So this is opportunity. In the business world, when investment analysts deal with this, they call this cannibalism. Okay, so it's where the one your new profit, basically your new venture eats into your current venture. It's a typical thing. Okay, so this is going to be loss of SA sales. Okay. So it's 5 million. So it's a cost. So we're going to say minus 5 million. 1, 2, 3. Okay. Okay. I think I saw 5 million. So it's 5 million rand. Annual loss is expected and to remain fixed. Okay. If investment 2 is selected, all profits from Zimbabwe will be repatriated to South Africa at the end of each year. The taxable income will be at the rate of 20. Okay. Okay, so we're happy with that. Assume all capital costs. Okay, so we took that into account at the end of each year. 12% is considered an appropriate discount rate for investment number 1. So 12% for investment number 1. So the appropriate discount rate is 12% for investment number 1. Okay. And then for investment number 2 is 12% plus a 400 basis point hurdle rate. Okay, so here they said a premium on the South African rate of 400 basis points is considered appropriate for investment in Zimbabwe. So this is going to be investment number 2. It is 12% plus 400 basis points. Okay, so the way you work out how much how to convert basis points into a percentage. So you just basically take the basis points. So you say equal the basis points divided by 100. Okay, so that is 4%. So it's going to equal to 12 plus 4. Okay, and we make it percent. Okay. 12 equal 12 plus 4. Okay, so it is 16%. So how you convert basis points? You just divide it by 100. You take the actual basis points that they give you and you divide it by 100. Okay, so the same thing, for example, when the Reserve Bank increased by 25 basis points. So you say 25 divided by 100. So they're increasing the interest rate by 0.25%. Okay, so that is basically the same thing over here. So here's 400 divided by 100. So it's a premium of 4%. Okay. So now we've kind of taken into account everything over here. All we need to go back to is the terminal value. Okay, so all we have to go back to is the terminal value. I'll see where this comes into play, but I will have a look. So let's work out this terminal value. So the way you work out the terminal value is as follows. Okay. So the way you work out the terminal value is as follows. Okay, so terminal value equals free cash flow in the last year. Okay, so in this case, it's going to be free cash flow number 3. Okay, multiplied by 1 plus the growth rate. Okay, so when you say free cash flow year 3 and you multiply it by 1 plus the growth rate, it is basically the free cash flow of year 4. Okay, divided by WACC minus the growth rate. Okay, so that is basically the formula. So actually, let me do it like this. That's free cash flow year 4. So free cash flow year 4, meaning it's the free cash flow in the next period after your explicit period. So our explicit period, this is our explicit period. Okay, so 1, 2, 3 is our explicit period. So when you work out your terminal value, you take this free cash flow must be the free cash flow of the period after the last explicit period. So the last explicit period is year 3. So therefore, this free cash flow must be free cash flow 4 divided by WACC minus G. Now, free cash flow, year 4 is equal to free cash flow year 3 multiplied by 1 plus G. And that is why I made the initial formula as terminal value equals free cash flow year 3 multiplied by 1 plus G divided by WACC minus G. Okay, so just take note of that. Okay, so we're going to work out investment 1, investment 2. Okay, so we want free cash flow year 3. We need the growth rate and we need WACC. Okay, and then this will give us our terminal value. Terminal value, continuing value is the same thing. Terminal value, continuing value is the same thing. Okay, so now let's go and work it out. So just take note of this. This must be divided by rand thousands. Okay, this must be divided by rand thousands. because all the numbers were in rand thousands. So therefore this 5 million must also be in rand thousands. Okay, so just be aware of that. Okay, so now we can work out the cash flow number. So it's going to be equal to sum I actually need to do the following. Because the terminal value needs to be an after-tax amount, so I'm going to take it out over there. The terminal value needs to be an after-tax amount, so I'm going to take it out over there for now. Let me just try to think quickly how this works. Tax on terminal value. Okay, it's fine. Also very important, like now the terminal value needs to be after tax. So I'm just going to set this up so that it is after tax. Okay, so there we go. Okay, so let's have a look what we need to do over here. So our cost is going to look as follows. So this is all our cost before tax. We took in everything into account. So if I drag that across, so that is our net cash flow before tax. Now, all of these line items have a tax implication. All of these have a tax implication. But in the question, they told us that that does not have a tax implication. Okay, so they told us this does not have a tax implication. Okay. Then for the equipment, they told us the tax implication for the equipment is they told us the tax implication for the equipment is this over here. And now all we need to still do is a tax implication of the operating cash flows. Okay. So all we need to do is a tax on the operating cash flows. So what we're going to do, the tax on the operating cash flow is as follows. We're going to take the negative of that number and simply multiply by 28%. Okay. So therefore, our net cash flow is going to look as follows. Okay, so now we're in a position to actually work out our terminal value. So now we're in a position to work out our terminal value. So we need the net cash flow after tax. So we want that number over there, the 9828. Okay, so it's always the cash flow after tax. So the cash flow after tax is as follows. Investment number one, it is going to be 9828. 9828. Okay, so just be aware of that. The growth rate, it was given to us as 6%. The growth rate was given to us as 6%. So there they're telling us under investment income and expenses are expected to increase by 6% per annum from year 4 onwards. Okay, so from year 4 onwards, it's going to be 6%. So they're telling you that's the growth rate for, that is the growth rate for the terminal value. WACC is given to us as 12%. Okay, so now we can work out the terminal value of investment number 1. So the formula says free cash flow year 3, okay, multiplied by 1 plus the growth rate. Okay, so if I close the bracket over here, that what I have in the formula so far gives me free cash flow year 4. Okay, now I divide by WACC minus the growth rate. So my terminal value is 173,628. Okay, so this year was working 1. Okay, so that is my terminal value. So now I can work out all of that. So now I can work out my present value. So my present value, I'm going to use the NPV formula in Excel or Google Sheets. 1 my rate. So that's my rate. As you can see, the value, it wants value 1, value 2, value 3, and so forth. Therefore, I start from value 1. So therefore, this amount given to me over here is the present value of these amounts over there. Okay? But we want the net present value. So the net present value is present value minus the value in year 0. So if I add this up, the NPV is going to be 48,000 Rand. Just one important aspect over here, or the terminal value. You can see the terminal value I have put into year 3. I did not put it into year 4. So very important to take note, because we are working out the terminal value from cash flow year 4. That means it is the value at the beginning of year 4. So this value is the value at the beginning of year 4. Okay, so the terminal value brings us the value at the beginning of year 4. Now, if you remember, each column over here represents the end of the year. So in year 1, it represents the end of year 1. Year 2 represents the end of year 2. Year 3 represents the end of year 3. Year 4 would represent the end of year 4. So I can't put this number in year 4 because because year 4 represents the end of year 4, but this represents the beginning of year 4. So which column is the most appropriate for the beginning of year 4? So the end of year 3 and the beginning of year 4 is the same thing. So therefore, we put it into year 3. Very, very important. When they give you a valuation and ask you to critically evaluate it, I can tell you, I can kind of guarantee you that what they will do is they will put this number in year 4 to see whether you know that it's actually incorrect and that it needs to be that the value brings the value at the beginning of that year. So the beginning of that year is always in the period before that. Okay, so just take note of that. So the NPV over here is 48,000. So now we can do the same story. Let me do the same story with this one over here. Okay, so I'm going to delete. I was going to bring the cash flow number over here. Okay, so we already did the tax on the buildings, so I'm going to follow the same thing over there. I'm going to say format. So the tax on the buildings, land and buildings. Okay. It's the same, so it has to be ignored. Okay, and then we had the building, the equipment, which was this. Okay, and now we're going to have operating income. Okay, so now we're going to have the operating income. Okay, so this is going to be the operating costs. Okay, which will be that. So I'm going to say equal sum. All of this over here. Okay, so this is simply going to be negative that multiplied by 28%. Okay, so remember the terminal value. The terminal value is going to be free cash flow year 3, which is the amount after tax. So I'll plug it in over there. So WACC rate we know is 16%. Okay, so
I just have a quick question. If
yeah.
they didn't say that there was a tax treaty between Zimbabwe and South Africa, if there was another country and they had a different tax rate, then we'd use
the different tax rate. Yes.
Okay, all right. All right, thank you.
Okay. So then the WACC is given to us as 16%. We calculated it. Sorry, did I delete that thing now? Okay, so this was 16%. I'm not going to put that formula. Hopefully, when you go through the video, you'll see that formula again. Okay. So that is that over there. This must be equal to that. Okay. Now we need to bring in the terminal value. Okay, so the growth rate. Now we need to have a look at the growth rate. I'm assuming they want us to use this as the growth rate, assuming that the risk-free rate, rates are currently 8% in South Africa and 5% in the US. These rates are likely to be maintained. I don't know how to get to the growth rate for Zimbabwe. They said financial forecast interest rates and inflation is unreliable. The directors of Pepper therefore assume for convenience that in investment to the income receivable in year 3 in South African rand terms will remain constant in nominal terms until year 15. Okay, so nominal terms would mean we must include the 6% inflation rate. So all I'm going to do is I'm also going to put here this the 6%.
Are we supposed to use the purchasing power parity theory for this?
Most likely. I'm not gonna how many marks are you gonna get for that? You understand? So so out of that, what comes to my mind was use a purchasing power parity formula. I don't remember the formula, so I'm not going to struggle on that. What I'll just do, you just make an assumption. So you'll say
spot rate, the forward rate is equal to the spot rate times 1 plus the inflation of the reference country, and then divided by 1 plus the information by the information.
Yeah, so you see, it's like a whole complicated, and probably gonna get 2 marks for it. You understand? So
for time reasons, it's better if we just
so I'm just gonna assume. So I'm gonna assume same rate. Assume same same growth rate as SA. Okay, so that, I mean, if I get this wrong, all I'm going to lose out is that 2 marks on that complicated formula I need to calculate. Okay, so that is
Okay.
why we don't worry about that. So there my terminal value now is 255. So if I plug in my terminal value, it's going to be the 255. And there we go. That let's see the thing is reading correctly. Okay, so there's the free cash flows. Discount rate 16%. So my present value is 212. 212 minus the net present value. And there we go. So based on NPV, investment 2 is more financially viable. Okay, so that growth rate over here most likely needed to use that interest parity scenario. In my view, I'm writing an exam, two marks. I'm okay with guessing this number, and losing that 2 marks. I'll lose that 2 marks, and I'll probably lose 1 mark in one more mark for not having accuracy. Okay, but other than that, just remember, the person getting 100% must get 100% if they got everything right. Person I get the correct numbers, but not 100% accurate. They'll subtract 1 mark just to differentiate between someone that got 100% who getting exactly the correct numbers versus someone that got kind of the correct answer but still went here or there wrong. Okay, so I'm okay with giving them 2 marks for that. Because in any case, I'm probably going to get that parity thing incorrect. I'm not going to waste my time. Okay, I don't know the formula, so I'm not going to try and doing it now. So I'm guessing, I'm just assuming that. And one of my rationales is this thing over here. Okay, they're saying it's going to remain constant in nominal terms, so we're okay with that. So that is basically what I'll do. And yeah, that's my conclusion. Do you have any questions on this NPV calc? It's a lot of information, but as you can see, it's best to go line by line and answer both at the same time as opposed to doing one at a time. Are we happy with that? Any questions, Sarina? Sarika?
No, I'm good.
Okay.
Everything was covered.
Okay.
I'm okay also, yeah.
Okay.
It makes a bit more sense now.
Okay, so so that was that over there. Okay, so I'm gonna lose internet soon in the probably next 5 minutes when City of Cape Town shut me down. I'm gonna read through this and see if there's anything I can say. As a senior finance manager, you are required to prepare a report to the CEO evaluating the investment decision and its funding. The report should include the following: evaluation or two, including a discussion of the key risk factors. Okay, so you must use your numbers in the previous one, but discuss the key the risk factors. A discussion on how the abandonment, timing, and the strategic features of each investment also may impact the investment decision. Okay. A discussion on the advantages and disadvantages of the 3 methods of funding outlined in using appropriate calculations where possible. Okay. So you can do 1 and 2. I'll just quickly run you through point number 3. So funding methods. Okay, so they're saying the directors of Pepper plan to utilize accumulated cash reserves of 20 million rand towards the funding of any of the projects. This is not expected to influence the stable dividend policy currently employed. The remaining capital investment will be funded by long-term borrowings aligned with the finance director's suggestions that debt should be used with relatively low current interest rates. Okay, investment number 1. If investment number 1 is chosen, the balance of the capital investment will be funded by a 20-year commercial mortgage secured on the land and buildings. Interest will be fixed at 9% per annum, payable annually. Okay. If investment 2 is chosen, the balance of the capital investment will be funded by one of the following methods. A 15-year commercial loan taken out in South African Rand at 9.5% interest per annum, payable annually in arrears, with the capital being repayable at the end of the term. Okay. A 15-year non-cumulative preference share is issued in USD at an annual dividend rate of 10% on the capital. A USD denominated loan from a bank based in the United States. Borrowing rates in the market appear very favorable at the present time. The interest rate will depend on the bank's perceived risk of investment. Okay, so they're not telling us the risk of investment. Okay, so when you discuss a source of funding question, okay, so I'm not going to go into the numbers, but I'm going to give you what you must always look out for when you discuss the source of funding question. So number one, in no particular order, but look at, you must look at the duration, you must look at the payment terms, okay, capital and interest dividend. You must look at the cost. Okay, so that's the three things you want to look at. For the duration, you want to have the duration of the financing to match as far as possible the duration of the investment. Okay, match financing with match duration of financing with duration of investment as far as possible. Okay, so that's what I have a look at. Okay, so the investment is 15 years. You want the loan also to be as close as 15 years as possible. Okay, payment terms. So match cash payments to cash earned from investment. So for example, if you're earning a regular cash flow every year, you want to most likely be paying the loan every year. If cash flow happens more to the end of the investment period, then you want the loan payments also to happen more towards the end period. So basically, interest can happen regularly, but then you want the capital payments to happen towards the end. You kind of want to match the capital repayment with that of the cash flows of the investment. Okay, because otherwise you're going to run into a cash flow problem. So the payment term, you want to have a look at the capital repayment. Is capital repayment evenly throughout the year? Is capital repayment all at the end? Is capital repayment like in tranches, for example, every 5 years? Stuff like that you want to have a look at, because that will impact your decision. You want to make sure that the large cash outflows of the capital of the financing must match the inflows of how you're going to make money on the investment. Okay, then cost. You must have a look at the cost of finance, taking into account tax. So for example, with preference shares, the cost is 10%. There's no tax deduction, so the cost is 10%. If you're taking out a loan and the loan is 11%, remember the cost of the loan is 11%, yes, but you do get a tax deduction. So ultimately, the cost of the loan would be equal to 11 multiplied by 0.72. Okay, so ultimately it's actually 7.92. So when you look at it, you see 11 for debt, and you see 10 for preference shares. So it may appear that preference shares is cheaper, but actually it's not. because there's a tax deduction for debt, and there's no tax deduction for preference shares. So always take that cost into account. That's all you're basically going to discuss. And that will give you your full 12 marks. In this case, I won't give you your full 12 marks, because in this case, you must also bring into account foreign currency. Okay, foreign currency, basically exchange rates. Okay, so basically you must look at that. So when you're discussing that, literally 2 lines for everything will bring you 2 to 3 new points for everything, and each point keep it a max to 1 line. If you're writing 1 point a paragraph, you're writing too much, they're going to get lost in the detail and give you 0 marks. So when you want to write a point for each one, 3 points or 2 points, 3 points or 2 points, 3 points or 2 points, 3 points or 2 points. Each point, 1 line, 1 new point. Okay, and then that will give you your marks. So that is basically how you would discuss that item. Source of finance will always be that over there. So here you can see a 15-year commercial loan, 9.5%. It's not 9.5%, it is 9.5% times 0.72. Okay, it's payable annually in arrears, with capital being repayable at the end of the term. Okay, so you must say that you must say that interest is payable annually, but capital is repaid at the end of the term. It doesn't not exactly match how the cash flows are earned in the investment. The cash flows are earned evenly on the investment, whereas this payment is made all at the end. Okay. So that is the, and it's a 15-year loan. It matches the investment period. The 15-year non-cumulative preference shares. Okay, so annual dividend of 10%. The cost is high, but it's non-cumulative. So if you miss the preference share, you don't have to catch it up, and you're not required to pay. You don't have to pay the preference share if you run into a cash flow problem, where over here you will have to pay the interest even if you run into a cash flow problem. So the fact that it's non-cumulative, any missed dividends will not have to be caught up. A USD dominated loan from a bank based in the US, borrowing rates in the market appear very favorable at the present time. The interest rate will depend on the bank's perceived. So the problem over here, we don't know what the loan term is. We don't know what the payment periods are. And one of the big problems is the fluctuation in the foreign currency. Okay, so that will be the discussion. That's all you're going to discuss over here. Over there is nothing to discuss. Okay, because you only have this one thing to choose from. Okay, so if you must choose from this, again, this will be cheaper, but this one has a little bit less risk in terms of if you have a cash flow problem, there's no problem. Okay, well, we can't choose much over here. This one all depends on the loan payment terms. What is the interest rate? What is the foreign currency rates? And then what's the payment terms? Interest annually. When is the capital repayments? That is basically what you discuss. You can't actually make an actual decision. Okay, so that is how you discuss this. You must score quite a bit. You must get like 80% for this question, because you're just telling them stuff based on theory, but using the scenario at present. Okay, I have 5 more minutes. Is there any questions on your guys' side? Sadika, Serena.
No, I'm good. Thank you so much for today.
Okay, you're welcome. Sadika.
I'm okay as well. Thank you.
If you have any questions, let me know. Yeah, then I'll try to respond as soon as I can. Okay, I will, once the recording is done, I'll try to upload. I can only upload after load shedding. So I don't have Wi-Fi during load shedding. And then, but it doesn't take long to upload. Okay. And then I will send it to you guys. Okay. Thank you. Bye-bye. All the best for tomorrow.
Thanks. Bye.
Okay, thank you. Bye.